Hey soldiers, as a former firefighter, I can assure you the global financial state is analogous to a house burning down. We are facing massive layoffs. Wait until you hear what Jim Farley, CEO of Ford Motor Company, said. Now, we need to talk about how you mitigate the potential for layoffs at your job, and also how you mitigate a slowdown in the economy if you own your own business. We really got to talk about these things. But first, we're going to see what PriceWaterhouseCoopers has to say about these layoffs, and then we're going to hear a grim prediction from Fed Chair Jerome Powell about the state of the economy.
Prediction?
Yes, prediction.
Pain.
All right, let's first take a look at this PriceWaterhouseCoopers survey. They went out in early August, surveyed 722 executives, and they came back with some really discouraging news that we can use to prepare for what's coming. PricewaterhouseCoopers compiled the data, and they said that 50% of firms are anticipating a reduction in overall headcount in the next 6 to 12 months, while 52% foresee instituting a hiring freeze, and 44% have rescinded job offers. That's pretty grim, right? Okay, but it is what's going on. This is a leading indicator of the slowdown in the job market. Now let's hear from Jerome Powell, because of late he's been uncharacteristically candid about the state of things to come. And we need to just, kind of flesh through his remarks at Jackson Hole, Wyoming, and take a better read of what we can expect.
The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal.
All right, let's stop him right there. He wants to bring inflation back down to 2%. He is referring to the headline number. Now, you know that number in August, it's published in August. July year over year, headline inflation was up 8.5%. This is not the number that includes or deducts from all the tricks they play to bring the number down. But let's just go with it. 8.5% headline number. Long way from that to 2%.
Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance.
All right, there he said it's going to take some time. And he used the word forcefully, which means he's going to be aggressive in terms of employing the tactics that he can. One of which, as you know, is an increase in interest rates. He wants to make money more expensive so that it'll slow the economy down. So if he wants to go from 8.5% to 2%, and he's just said, he's going to do what he got to do, then hold on to your butts.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses.
All right, you heard him. He said higher interest rates, so money's going to be more expensive. That's going to slow things like the housing market down because it's going to cost more. The interest on a home loan or mortgage is going to be higher. Okay, interest rates on credit cards are going to be higher. Okay, so people are going to think twice. Car loans, higher interest rates. Okay, so he's going to do that. He says slow down in the growth, of course, because of the things that we just mentioned. Growth is going to slow, so that means the stock market probably will remain in kind of off of those highs that we've seen in recent years when there was just money everywhere, right? That's not a bad thing necessarily, because that gives you an opportunity to take a look at the equities markets and find bargains among quality companies, okay? So remember, we are going into this situation as soldiers of finance. We're not going into the situation, wringing of hands and gnashing of teeth. We know what's coming. We're going to approach it like men and women, and we're going to thrive through it. So that's one of the positives. Even though he's saying this growth will slow, Corporate profits are going to slow with that. And then, stock prices are going to moderate. That's called a buying opportunity. Now, the last thing he mentioned, of course, was a softer labor market. And he's up front. He said it's going to cause some pain, not just to households, but to businesses. Okay? So, softness in the labor market just means that he anticipates layoffs. Okay? And remember, go back to what he said in the beginning about this taking time. So this is going to be the type of situation that we're potentially in for, I would imagine 18 to 24 months. Now, that's if the Fed operates independently. Now, there is a possibility that politics will become part of the equation. Now, we are riding into the midterm elections, right? All right. And the Democrats look like they're going to lose big. And I think that they kind of accept that for the midterms, but they're not going to accept it when we're going into another opportunity to switch the composition of Congress and also for them to hold on to the White House. So that's why I say I think it's going to last for about 2 years. And then you're going to see political pressure to do whatever the hell is necessary in order to get the economy going. Because James Carville, he was an advisor to President Bill Clinton. James Carville had it right when he said,
That is really the economy, stupid.
It's the economy, stupid. That's the main thing that Americans care about. You can throw in Ukraine and all this stuff happening overseas. Americans don't care about foreign policies. Most Americans could not identify Ukraine on a globe if you threaten to take away their firstborn. They just don't, they can't do it. So Americans' knowledge of the permutations of domestic policy is oftentimes challenged. So there's no hope of us knowing what the hell's going on in Mogadishu, right? So those domestic issues, the ability of an American to feed his or her family, the ability for them to go out to dinner or enjoy a show, buy a car, buy a home, they've got to be able to hang on to some semblance of the American dream. If that's not possible, then the first thing that happens is the makeup of political leadership changes. Now, part of the solution to this, of course, we talked about the fact that you're going to quite probably see a lot of bargains out there in the stock market. So that's a buying opportunity for you to acquire assets on the cheap, so to speak. And that's what you want to do. You want to buy low, right? Now, as I always say, you know what I'm going to say next. You got to do your own due diligence. I can't tell you what to buy. You've got to figure that out on your own. But I would suggest that you look for the highest quality assets that you can find at these good prices that are coming. And those assets don't just include equities. They also include commodities like gold and silver. Why would gold decrease in value against the dollar? Because we're raising interest rates? Because it appears as though he's trying to fight inflation. And remember, inflation, or gold rather, is a hedge against inflation. So if he gets that number down to 2%, then gold, it's not going to be looked at as much of a hedge for something that is, barely registering compared to what it is now. 2% versus 8.5%. Again, headline numbers. So we got real estate. That's another one. Real estate's going to go and be more affordable because sellers are going to try to balance that increased interest rate with their sales price because they know there's going to be an affordability gap with people who are trying to purchase real estate, whether they be trying to purchase for corporate purposes or, investment purposes or for the purposes of living in the structure. So we're going to see real estate prices moderate. So all of those assets are going to be in a position where they're going to be on sale. And don't worry. The economy is cyclical. One day it will swing back. And guess what? If it doesn't, and you own some gold or some real estate, some quality companies, then I'm sure you'll be just fine. Let's say the worst happens. Let's say the economy doesn't come back, and let's say we are invaded by aliens, and They announce on the news that a meteor is going to come and it's going to just wipe out the entire population of Earth, aliens included. Well, then your stocks, your real estate, and your precious metals won't matter. So we'll just operate on the assumption that what's going to happen is what has happened in the past, and there will be a cyclical recovery of the economy at some point. Now, please know that I am stating that independent of the status of the dollar. Even if the dollar went away, because I'm always talking about the dollar losing reserve currency status, slipping below 50% of global reserves held by 2035. That could happen tomorrow. But guess what? You're still going to need to live in a house. You're still going to need to eat. You're still going to need to communicate. You're still going to need to buy software, hardware. All those things are going to continue. Okay? So the economy will come back at some point, and you want to be in a position where you have acquired some assets during the trough, okay, during the depressed time or recessed time, and as those assets start to increase in value and we get up here, then now what? You're sitting pretty, right? All right, I promised you I would talk to you about what Jim Farley, CEO of Ford, said. I want to talk to you about this because this is the bucket of cold water that some need in order to understand that a job that can be transitory. Okay, this isn't the 1950s, 60s, or 70s where you could go work somewhere and be reasonably assured that you were going to work there for 30 years. That paradigm shifted and disappeared a long, long time ago. So these corporate managers, when they make these decisions, okay, from on high, they don't see you. They see a balance sheet. They see profit and loss statements. And they see what they have to do to adjust the most expensive part of the equation, which is the human capital, in order to get the operation mean, lean, and profitable. Okay? So no one's sitting anywhere saying, Tyrone's a good guy. He's got a wife. And he's got a dog. And they all need to eat. No one's thinking about me. They're thinking about a number. Jim Farley exemplifies that perfectly when he says, we absolutely have too many people in some places. No doubt about it. Now, he said that in relation to some information that he was providing the media with regard to Ford decreasing personnel. Ford Motor Company revealed plans to lay off 2,000 salaried workers and 1,000 contract employees effective September 1st. That is a couple of days from now. I'm recording this on the 28th. The cuts will take place in the U.S., Canada, and India, with a significant percentage of them in Michigan, according to the company. Last month, Bloomberg News reported that Ford was planning as many as 8,000 layoffs this year. Okay, so the layoffs are coming, folks. Establish another stream of income. This is what we're going to end with, the emphasis on this. You have got to establish another stream of income. You got to establish as many as you reasonably and practically can. Keep in mind that when you're investing in the stock market, typically we see the S&P has returned between 8 and 20% over the course of 20 years or so. All right? Good. 15 to 30% returns. That is what can be expected from a business you own and manage. Okay? That's according to Cabbage, the lender. Now, 15 to 30% is great. 8 to 10 is good. 15 to 30 is great. You're not going to find a return on any asset other than your own business. You're not going to find a greater return on any asset other than that one. So strongly consider that. As I always say, if you want to get more information about starting a business in the financial services industry, then go to mcenow.com. Just leave us a message. Tell us that's what you want to get more information about. There are no obligations here. You do what you want. We give people information for free, just like we're doing it here on this channel. So if you want to take a look at real estate, and you might be saying, well, why real estate? Because when the 2008 crash happened and we had our real estate company, guess what? We retooled and we thrived all the way through it. Now, a lot of real estate agents fell by the wayside, but we weren't one of them. Our company just thrived on through it, came out the other end better than it went in. So even though economic trials occur within the economy, again, it's cyclical, there are ways to, thrive through those situations, even though revenues might moderate for a period of time. All right, guys, as a follow-up to this video, I want you to go now and watch this one. It's about how Jerome Powell really is engineering a recession, and we get deeper into the details of why that is happening. So go ahead and watch that. It's a perfect follow-up to this video. Guys, I will talk to you soon.